This channel is for educational purposes only. Please do your own due diligence before making any investment decisions. Hi, this is Joe. Welcome back to the channel. And today I want to talk about reverse divergence or hidden divergence. I had a specific request to go into this in a little bit more detail. I talk about it in my book, and I have done a few videos on it, but this is the type of signal that I think you need to see more examples of, because actually it's incredibly powerful, especially when it happens at the right time. And so let's go ahead and get into the example, because in fact, I have two different examples. And one of the things that I think is important is recognizing where, and this goes for not just this reverse divergence signal, but any of the signals that I use, is figuring out or recognizing where it is in relation to the trend. So if you get a signal in any of these signals and it happens early in the trend, where the trend is really just getting started, that can be the kickoff move for the whole trend, and actually just give you an early signal that you can play for a much bigger target. But if it happens later in the trend, after it's already made a breakout move and a pullback move, and this is the second move in the uptrend or second signal in the uptrend, then you probably want to play it for shorter targets. So that's how I would consider. That's how I think look at it. And again, and that would go for any of the other signals that I use. Now, MACD has some really nice trading signals like the pinch plays, but again, you want to look at it in relation to where you are in the trend. So that's the first thing. So when I look at, so let's just first talk about standard divergence. So if price makes a move to the downside, rallies up, and makes a lower low, yet the MACD comes down, makes a low, rallies up, and makes a higher bottom. Now we have divergence, because this is making a higher bottom and this is making a lower bottom. Now we always look for confirmation in price before doing anything when we have this type of divergence. And in fact, any type of divergence or any signal, I'm almost always going to wait for the price to confirm. However, when you're looking at reverse divergence, we've got the opposite going on. Price comes down, makes a low, and then comes down and actually makes a higher bottom, while the MACD line comes down, rallies up, and makes a lower low. So this is coming down and making a lower low, while price is making a higher low. So that's why it's called reverse divergence. Now, one of the things I really like to look for is, as you know, I'm a big zero line, MACD zero line guy. And so I am watching for a specific signal to take place near any time. So if we get across to the downside in the MACD lines, I'm looking for the pinch right there, or to the upside. I love the pinch play right near the zero line. If we're looking at reverse divergence, let's just use this example. First, we'll talk about the Starbucks example. So stock makes a move to the upside, pulls back, and we get a new high in MACD, and we pull back, and there's no sign of divergence whatsoever. It's convergence. It means that the indicator is doing exactly what price is doing. But then we make a higher high here, and this actually is standard divergence developing to the downside. Now, one of the things that I would tell you is standard divergence against the trend is not a meaningful thing. It's most of the time it's just telling you're going to get a pullback to the moving average. It's not necessarily calling for a big reversal in the trend. Now, if we get something a little bit more meaningful in ADX to confirm that divergence, then we can look for something more significant, and that's when ADX can't get above 25. I've talked about that in other videos. But look at what happens. So we've got a bottom here, and we move up. And then we get another bottom forming, well, at least a pullback here. And this made a low in MACD back here, if you look at it compared to that. And then we rally up, come down, and then this makes a lower bottom. So we're lower here, we're going lower here, and we've got a significantly higher bottom here. Now, the fact that this is taking place, like I said, after you broke out, after you've had a pullback, it's already made somewhat of an extended move, and you do have a sign of standard divergence potentially developing. What I would tell you is I'd be willing to take this trade, but I would play it for a trading move of 3 to 5, 6 bars, something like that. And I'd be watching it as it's moving, looking for signs of on the actually go down a time frame to the daily chart and look for signs of either divergence or some kind of a big upside move bar, something, take advantage of getting extended away from the daily 18. Any of those would be potential exit points. But this is a pretty good signal when you get the lower low here and a higher bottom here. Now, if you notice what happened, now we have this bottom, and after this rally, now we have this bottom, we made a lower low in price, and we made a lower low in MACD. So that's convergence. They're in agreement. So price is doing something, and so is the MACD. It's doing the exact same thing. Now, we did have a layer of standard divergence at the peak, because this made a higher high and this made another lower high, and this time the ADX did not confirm by getting above 25. So then you could look for something a little bit more meaningful than just pulling back to support. Okay, so that's one example. I want to give you this other example because this, I think, can really help us and when we're looking for a bigger move out of this trade. So let's look at the bottom that was made. So first we can look at this low versus this bottom. So we made a higher bottom here, and we did make a lower low here. It did follow divergence, and you had kind of made a decent move to the upside. So again, it's more of a trading move, 3 to 5 bar move to the upside, and all it did was test the high. Still not a bad trading play, especially if it's happening on a weekly chart and you go down to a daily and you want to swing trade, knowing that there's some potential getting back to this old high. But what I think is more powerful is when we compare this bottom to this bottom. Now we've made a higher bottom in price, but look at this lower low happens near the zero line. Notice how the ADX is very low. So when we see that, and I'd almost prefer to see these moving averages come together, something like that, and have one of our signals from the moving average standpoint. That didn't actually happen, but sometimes it'll happen quicker like this. And that's okay. So I would be going down to the daily chart during this phase, looking for a signal to play it to the upside. Normally, I don't play this off the same time frame, meaning this is just a backdrop, this is the setup, and then I want to go down to the daily chart to look for a signal that's going to get me in for a move to the upside. So that's how I go about doing it. But notice what happened here: zero line reversal with the lower low, which is a reverse divergence at the zero line. Look for this pattern when you can get that opportunity. I think it's pretty powerful when you can get that to happen, especially if there's low ADX in place. Now, if you notice, I would still consider looking at this as a profit-taking opportunity here, or during this bar somewhere, because look at this move. You made a nice move to the upside, and you get this extended, huge individual bar that takes place. And so, when I see that, I'm inclined to want to take profits when I see that. But you could have scaled and trailed in this situation because it was starting at the zero line and played for a little bit bigger move. If you were down on the daily chart, you'd have seen some signs of divergence that would have helped you exit this trade. So anyway, that's the example I wanted to give, a couple examples I wanted to give, just to give you a little bit more insight into the reverse divergence. I mentioned it on my last video with respect to a trading play on the market, but I just wanted to give a little bit more detail and a couple of different examples. So post any questions or comments, and we'll see you next time.